I made $15,000 selling puts on a single stock, and I thought I had it all figured out. Then I got assigned 1,000 shares of it, and suddenly, it wasn't so simple. The decision I made in that moment turned out to be the best stop loss I had ever set. And what happened after I exited? The stock dropped from $30 all the way back down to $15. I got lucky, but I also got out. And those are two very different things. Last episode, I talked about walking away from zero DTE options trading after the FOMC strangle that nearly wiped out our whole community. I mentioned I got pulled back into options through a completely different strategy. This is that story. Quick disclaimer. Before we get into it, I'm not a financial advisor. This isn't financial advice. This is just my story. So after I stepped away from zero DTE options trading, I went back to just trading stocks for a while. Options felt too volatile, too fast, too emotional. That was fine for a stretch, but I eventually found a corner of YouTube that was selling a very specific idea, selling cash secured puts on popular stocks as a way to generate consistent income. The pitch was actually pretty compelling. You collect the premium up front. The stock has to drop significantly before you're really in trouble. And then if you do get assigned shares, you just sell covered calls to work your way out of it. It's called the wheel strategy. Compared to what I'd been doing, it sounded almost too conservative. There were a few creators I was following who were very enthusiastic about stocks like SoFi and Robinhood specifically. Lots of options volume, good premium, very popular with retail investors. They made it look almost passive. What I will say is this: the strategy itself isn't the problem. Selling puts can absolutely be a legitimate approach. But the stocks they were pushing, the position sizes they were encouraging, and the risk management they were glossing over, that's where things get interesting. I started selling puts on SoFi, and for a good stretch, it worked really well. SoFi was trading around $15 a share when I started. For the options enthusiasts, I was selling puts at a 30 delta, a month out, and 10 to 12 contracts at a time. The premium was solid. Trades were closing in the green. Over time, I had built up $15,000 in gains just by following this approach. And SoFi kept climbing. $15 turned into 20, 20 turned into 25, and by the time it was pushing $30, I was feeling pretty good about myself. Right around this time, I discovered and paid for Seeking Alpha. And that changed my perspective pretty quickly because Seeking Alpha wasn't talking about SoFi. It wasn't hyping Robinhood or Palantir either. Not that those stocks are necessarily bad stocks, but the Seeking Alpha quant system was pointing at a completely different tier of opportunity. Stocks with real fundamental strength behind them, not just real momentum. I started to realize I'd been fishing in the wrong pond, but I still had SoFi positions on the table. And then I got assigned 1,000 shares of SoFi. Here's where the math landed. I'd collected $1,200 in premium on the sold put, but now I was holding shares that were 50 cents below my strike price. So even with the premium, I was essentially flat to slightly above water, and SoFi started to trickle down. So what did I do? Do I hold and wait for a better return, start selling covered calls, and chip away at the cost basis? Or do I just get out? Here's what I decided to do. When SoFi was 70 cents below my strike, I sold the shares. So more math. $1,200 collected in premium minus $700 in losses on the stock. I walked away $500 on the whole trade. Not a home run, but a win. And I want to be clear, that mental decision to get out was the single best stop loss decision I've ever made because after I exited, SoFi dumped hard. $30 all the way down to about $15 to $16. If I had held trying to sell covered calls and waited out, I'd be sitting on a massive loser right now. Instead, I had capital in my bank, a small gain, and a very important lesson about not falling in love with a position. That exit freed up capital. And with Seeking Alpha now on my radar, I started putting money into the stocks the quant system was actually flagging. Names I genuinely would have never found on my own before this. I'll be honest, there was one more bad trade in this era. There was a creator who put a video out around Christmas of 2025 recommending that I sell a put on Palantir. The argument was that volume gets thin around the holidays. The Santa Claus rally could pump it, and there would be easy premium. I went for it. I got assigned 100 shares of Palantir, and I took a $2,000 loss when I got out of it. I used TrendSpider's Sidekick tool to build an exit strategy that stopped it from getting worse. That was the last time I started following someone else's trade without running it through my own framework first, because by that point, I was finally starting to build it. The SoFi exit was honestly the turning point, because while I was getting out of that position, I was discovering that there are people out there who actually knew what they were doing, who used data in systems instead of gut feelings and YouTube hype. Seeking alpha, outlier. Analysts who weren't peddling the free stuff that leads nowhere. And in the next episode, I'm going to introduce you to the tools and the people that changed how I invest. And I'm going to tell you about the stock they eventually pointed me to, the one I bought at $280 a share. Subscribe so you don't miss episode 4. And drop a comment if you'd held a losing position or if you've ever made the right call and gotten out of it just in time. I want to hear about it. See you next time.